Hello and welcome. Well, for those who are unfamiliar, KYC is a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. And as I mentioned, this is the second KYC we are doing. The second KYC is going to be on Gensol Engineering. Now, we have been talking about Gensol Engineering quite a bit through the course of the day. So let's start by taking a look at all the highlights around which we are going to have this discussion. For this, we have with us Mihika and Somit joining us to take us through that. Well, both of you, take it away.
Well, firstly, starting off with the business segments of what does actually Gensol Engineering do. It is engaged in solar consulting and EPC business. It has also an arm which is into EV leasing. It recently also entered into battery energy storage. So basically, these are the business model of or the businesses of Gensol Engineering at this moment. But in the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%. In fact, from peak, if you look at, the share price fall is more than 70%, and the 1 month market cap loss is close to 1,600 crore rupees. So what went wrong here in the last 1 month? Mihika, please tell us.
Yeah, well, the company is in focus for all the wrong reasons. The initial trigger was a rating downgrades to the long and short-term bank facilities to a default by both Carriage and ICRA ratings. Now, as per Carriage ratings, the ratings were revised on account of ongoing delays in servicing term loan obligations as per feedback from the company's lenders. And ICRA rating stated that no default statements shared by the company on its debt servicing track record are falsified. Now, this raised concerns on the company's corporate governance practices as well as its liquidity position. Now, if you look at the debt and liquidity picture, a key question that NDTV Profit is asking is that if the company had the liquidity of 250 crores as stated in its Q3 con call on Feb 13, why are the rating firms calling the debt payments as defaults? Now, in terms of where did the money go? Now, who can answer this question? Well, the company's management declined for the interview. Suresh Surana and Associates LLP, the auditors of the H1 FY25 performance, and the now resigned CFO of Gensol Engineering. If you look at the total debt picture lastly, it's 1,146 crores as per the latest statement. This compares to the last 12-month EBITDA of just 330 crores. Leverage of the company now stands at 3.5x. But there's also another trigger, Samit. What is that?
Well, in fact, more than trigger, they're also, I guess, trying to address the liquidity issue here. Now, what the promoter has done recently is they have sold close to 11.5 lakh shares. In fact, on Friday, they sold close to 9 lakh shares and they derived around 30 crore out of this. But they are planning to infuse this 30 crore back in the company going forward. That is what the plan is. But how they will do that? Now, last year, they had issued some warrants of around 61.84 lakh warrants to promoters and to other investors as well, and this was done at around 871 rupees per share. Now, out of the 61.84 lakh warrants, 15 lakh were subscribed by promoters, and only 25% of the warrant subscription money had come in the company, that is close to 135 odd crore rupees. So the remaining 404 crore is something we believe that the company could call upon from the investors and the promoters. Now, out of this 404 crore rupees, 100 crore is something that the promoter has to put in the company. So that is how the promoter will look to infuse the funds in the company, while the remaining 304 crore is something that they will get from the other 107 investors. Now, the key question here is, will the 404 crore rupees will be honored or get devolved, since current share price is much lower than the conversion price. In fact, if you look at the conversion price of 871, it is nearly 2.7 times or nearly 3 times the current market price, which is around 300 to 310 rupees. And also, will this 400 crore will be sufficient enough for the company to meet its liquidity requirement?
Because the 400 crore balance is only 35% of the total debt, but the company has lately announced 2 divestment schemes in which it aims to reduce 665 crore debt, taking its net debt total debt to equity to 0.8. Claim 1 is to sell 2,997 EVs to Refex for a total of 300 crores. The update on this deal is it will take another quarter at least to be completed. The second claim is to sell the US arm for 350 crores. However, the transaction is only expected to be completed by March 26. And even though one of the, you see a 7,000 crore order book, but there's a problem with this order book, Sumit. What is it?
Well, as a 7,000 crore order book on the books looks very much high for the company. But you need to remember that out of the 7,000, Nearly half of it was the orders that the company received in the last quarter, that is the third quarter of FY25. However, they also mentioned that this order execution has been stalled due to land acquisition issues or land transfer issues with the developer, and now they are expecting these orders to be executed over the 18 to 24 months. Earlier, the order execution time period was much lower, and now this has extended to nearly 2 years by the company. So though the order book is very high, around 7,000 crore rupees, the execution time period is also over a period of 2 years nearly.
Yeah. And lastly, we'll talk about the income statement. Their FY25 revenue target was stated at 2,000 crores. 9-month FY25 of reported top line stands only at 1,056 crores. And it looks like the company may miss its revenue guidance for the second consecutive fiscal in FY25.
Okay, well, Mihika and Soumit, thank you so much for joining us and taking us through that. I will make a very quick addition to some of these claims here. Besides the fact that we've spoken about the shareholding being sold into, we've spoken about the current debt and how the company may or may not be able to retire a lot of that debt, and of course the current order book picture, and there are some challenges with respect to execution of this order book. One aspect related to that is the revenue recognition bit, because over the past some time, over the past few months, the management has suggested that they're likely to make 2,000 crores in terms of its top line in FY25. In fact, as on the 9 months ending December 2024, they have only been able to manage about 1,000 odd crores, which means that they'll need to do another 1,000 odd crores in terms of execution in the ongoing quarter. That's another big question mark, whether or not that can come through or no. But we've been actually talking about this particular story through the course of the day, and well, I now have with me Sajid as well as Vishwanath, my colleagues here, who have a lot more in terms of insight into what's going on. So Sajid, I'll start with you. What more have we come to understand here, and what are the important questions that still need to be answered?
The first question, as Mika mentioned, there was 250 crores of cash in the books. If you look at the audited limited review balance sheet, which came in September of 2024, it gave clearly marked out that roughly around 220 to 30 odd crores of money was lying as fixed deposit in the banks. Yeah. In the Q3 earnings call, they categorically stated that there is an operational cash flows which are coming in, and they have enough liquidity for operations. Remember, this company is not only undertaking EPC, which requires a lot of working capital, but also is undertaking a capex program, which was to set up a manufacturing unit for the EV electric vehicle, which they are trying to come out with, and so they were of the view that they already have the liquidity there. And certainly, we have two credible credit rating agencies on March 4th coming and downgrading the stock to D, to a default status. And further, ICRA went ahead and said that the company has been falsifying documents which on a monthly basis, stating that they've been current with all the debt service which is there, which is not the case, because the lenders have approached them and they've told them that there is an issue with the debt service which has come in. So where did the cash go out? Second thing is that just look at the P&L of the company. For 9-month period, it had a finance cost of 180 odd crores, which is there. Company in the earnings call said that we have a debt of 1,150 crores. Now we are talking about a gross debt of 1,150 crores and an annualized interest or finance cost of roughly 240 to 50 crores. Yeah. Which basically means that it's not the lenders which are giving them. There's a private credit which they have been taking about it. Though the rating agency has, rated roughly 2,000 odd crores of the bank facility, which is long and short facilities. Yeah. There is extra lending or borrowing which has happened off books, which has happened, for which they are doing it. It's in my opinion. And why I say that is when you look at the encumbrance of this or the pledged shares, the shares have been placed to private companies and not to private public lenders, basically. Yeah. And so if that's the reason why the shares have been placed to those companies, and they've raised money from there. So that is the multiple questions with respect to liquidity of this company and what they have stated, actually it is true or not.
Right. So Vishy, you spoke to the management. There were some clarifications. How much of it helps all the issues that have been raised by Soumit, Mika and Sajid right now?
To be fair, Agam, this conversation was not exactly clarifying anything more than what the company has already clarified to the exchanges, right? Like first of which is the fact that they claim it's not a default that has happened.
Yeah.
But the rating agencies are very clear. A 0-day default regime is what we have right now. If you've not paid today, you're in default. You may turn NPA 90 days later, as far as the bank number is concerned, but you are in default. And that part, the company claims that they will clear very soon. Debt obligations are being handled anyway. There's probably one more that is left that we will clarify. We'll clear. We don't know what the status of that is because even the rating agencies didn't know till March whether there was such a default in place or not. The other clarity that they were providing is that we had originally pledged only about 50 to 60% of our shareholding to lenders for loans against shares, but we had to pledge more because share prices started falling and therefore the margin requirement came in and we had to pledge more shares with the lenders, and that's why the number is looking so high. Otherwise, it's not so bad. They believe that they can bring it down to a zero pledge company. Anybody's guess when that will happen and you know how soon the company will be able to raise funds enough to release the pledge on their shares. Another important part of this conversation was why the debt was taken in the first place. Now, according to the company, they've taken about 250 crore worth of debt from PFC. This was to fund their EV business, and that is why that pledge exists. And now that they are actually going to go ahead and sell about 3,000 vehicles to Reflex as part of one of the deals that Mika was talking about. That will bring in about 315 crore and therefore we can release the pledge that exists. Now, they are saying that the deal will happen next quarter, at some point in time next quarter. We don't know when or how soon that transaction is going to take place, whether Reflex has the funds to actually release that pledge or not, and whether the lenders are going to be okay. Because remember, if you've borrowed money, you need a lender's NOC. To actually make that transfer. So whether the lenders are okay with that or not, we don't know right now. And in any case, this is 4 months later. This is not today. Right? As part of the debt reduction plan, another thing that the management has repeatedly said is that they're going to sell this US-based subsidiary, Scorpius, for 350 crore. We don't know who the buyer is. And that transaction is at least a year away. So when will that transaction take place? Will that transaction actually take place in 12 months from now? We don't know, and therefore we still await the some more clarity. We had actually sent out some of these clarifications or questions to clarify these points to the management. The management just declined to come on the channel to clarify these points. But it's important to note that without these clarifications, the statements don't on their own hold a lot of water, especially because statements are consistently being proven wrong and transactions are being taken place which are different from what they were originally pictured to be.
Right. Absolutely.
So just to add to it, they came out with a preferential warrant issue in June of 2024 at 871 rupees per share. And the regulation says that they have to pay 25%, remaining 3/4 has to be paid within 18-month period. So that comes into play in December 2025. 871 was a price. Today we are at the price is around 300 odd rupees. It's uncertain who will come and convert the warrant into shares. No one would like to come and convert a warrant into share at 871, pay the money and take a loss of 500 rupees on the books. Unless it's a tax harvesting which is happening at this point in time. So that is a big issue which is there. So the promoters claim that they will convert their portion of it. But if that was the case, in September and October, they bought from the open market. They should have converted the warrants and infused money into the company. But that didn't happen. It was an open market purchase which was undertaken by the promoters there. So, there are multiple questions of why they have acted in a way they have, and there is a limited answer which is coming from them with respect to liquidity, where the liquidity went and how they will be able to. They're depending solely on two major diversification or divestments. One is a Reflex one, and the other one is a Scorpius. But both of them will take at least a quarter to a year to come. Until then, there's a liquidity crunch, and they will have no other option because the lenders are not going to lend further.
I want to add, they're going to do this board meeting come Thursday, right? Where they're going to discuss some kind of equity fundraise. They're also going to, they're also, I think, deciding on a stock split that is likely to come in for the company. Now, interesting to note that whether you do a equity fundraise decision by the board,
Yeah.
you have about a year's worth of approval in place, but who are you going to go and sell it to, and where are you going to? A lot of your own
Absolutely,
shares
yes.
are currently pledged
Yes,
with
yes.
the lenders, right? You're already sitting at about 81, 82% odd of your holding is pledged with other lenders. What are you going to sell to a potential investor?
Yes.
And you're also consistently selling equity in the market, whatever is freely available with you. You're selling it to address day-to-day costs. So. Important to see whether an investor actually turns up, whether there's a white knight in the picture. And if they do come into the picture, then what do they do with the promoter's position? Right. Now, according to the clarification the management has provided to me during my conversation, they believe that the promoters will remain in control and they're not going anywhere. But I'm yet to see an investor who will walk in and look at the kind of governance questions that are being raised and the kind of financial difficulties that they're in. Why would they want to take only 5-10%, right? Like, probably you would want to take a significant chunk of it, in which case there's going to be a rejig on the board.
Right.
And just to add, he spoke about the pledge one. The pledge data is as of December end.
Yeah.
Post that, there's a huge stock fall which has happened. So there will be more pledge which needs to come into place.
Right. And of course, the stock split aspect, it really doesn't help the company because it's not going to mean anything for the balance sheet. You know, there's been a mention by the promoters, they want to provide liquidity in terms of their stock trading and all. It doesn't work that way, even if the stock split does come through. But that's another minor point that I want to make a mention of. That said, we do have with us Aditya Shah. He's the founder of Hercules Advisors, who also joins us to give us his perspective. Aditya, you've been tracking the stock for quite some time. You've also been talking about the fact that this particular stock has run up for no apparent reason over the past many months. Of course, notwithstanding the recent correction that we've seen. And eventually, a lot of that has come through and played out. I want your view firstly on the several aspects that we've spoken about and in terms of the position at which the company is right now. What can you tell us?
So, good afternoon. Gensol is a classic case of cash flow mismatch that is really happening. The company, according to one of the rating agencies and one of the lenders, has not paid its debt obligation since 2 months. Mind you, Gensol's debt obligation per month is about 10 crore rupees, and it has not been servicing that obligation for the last 2 months. That's what we are given to understand from one of the lenders. So what is really happening is they were very, very aggressive in their EV business, manufacturing of EV, and that's a very cash burning business per se, and the company does not have any cash flows per se. So if I were to summarize within few words what happened at Gensol, cash flows were really very poor. They went into a very capex heavy business, and on top of it, they kept raising equity. At some point in time, that equity will die down. At some point in time, the investors will say that you're diluting way too much. And slowly and steadily, as the cash flows continue to dry up, problems started at Gensol per se. Mind you, the corporate governance is not is something to take note of in Gensol. They kept issuing press releases. They kept saying that we have 7,000 crores of order book. That all is okay. But if the company does not have access to cash flows, it is but obvious that there is going to be a problem. Now, once a rating agency downgrades a stock to D, no lender is going to touch them. They will have to continue to do equity infusion per se. And now the massive problem starts for Gensol. So in my opinion, this is a downward spiral that the company is going through, and the seeds were laid already by the management by not focusing on cash flow, cash-rich businesses, and they tried to diversify into too many businesses per se, which were cash burning per se, particularly the EV manufacturing business. So net, poor corporate governance, poor cash flows, limited access to capital, and now promoters pledging them out, and time and again trying to put out statements which were not exactly a true picture of the company. Mind you, one of the rating agencies does say that they have evidence of falsified information being shared with the rating agencies. So there should be an investigation as to why the rating agencies did say this, and SEBI should get involved and the MCA should get involved and understand what is going on in this company. Right now, the situation is very precarious for the company per se, and investors should be really very careful on this.
Aditya, Vishwanath here. Let's talk about the corporate governance issue a little later, but I want to first talk about the business dynamics here. Is this a classic EPC story where what we've seen maybe in the last, maybe 10 years ago, where a lot of EPC companies were just not able to roll over their debt or be able to execute any of the projects, and that led to the demise of a lot of those companies. Are we sort of seeing similar trends?
Exactly, Vishwanath. We are seeing that the cash flow, the EPC business was pumped up in 23 and 24 on the basis that it is a renewable energy business and it will do pretty well. But what really happened is the cash flows were not chugging in for Gensol. And mind you, with their Blue Smart business also, that was also a cash burning business per se. So what you really find here is most of the businesses for Gensol were cash burning businesses, and no business per se was bringing in cash flow that could help in day-to-day operations. As a result of this, Gensol has gone on a cycle of equity dilution time and again. Over the last 2 to 3 years, it has diluted about 4 to 5 times per se. And this sort of dilution just points out to one fact that the company does not have money per se to run the day-to-day operations per se. Given with that fact, uh, uh, and the ability of the company to not service debt right now, it is a problem. And as you rightly pointed out, this is a classic case of cash flow mismatch, and the company has no control over its cash flows per se. So, from my perspective, I had pointed out this in 24, whole of 24, that cash flows are not there, and constant equity dilution is a big red flag in a company.
Okay, I wanted to add one more question here. So the cash flow issue now, according to the company, this is a temporary issue, a small, amount, which can be addressed soon. Let's assume even that is even right at some point, right? The next logical question is, what about all of these corporate governance questions then? Because even if you stabilize and you normalize your debt situation and somehow come back into doing business, the corporate governance questions still remain. The point is that you led the market to believe a certain financial position, which was not true. You led the market to believe that actions you're taking are towards liquidity, but you failed to mention that the issues are far deeper than what you were looking to address. Those questions will still remain, right? Irrespective of where the financial position ends up being.
Absolutely. Vishy, so no rating agency writes in their research report that they believe that they have evidence of falsified information. If ICRA would have had some concrete evidence, only then they would put that out in writing. I believe now this is the time for SEBI and MCA to get involved for to protect the interest of minority shareholders, to figure out what exactly has happened, how the rating agencies find out that the financial position was falsified to them, and steps should be taken in order to stop this. And if promoters had falsified that evidence, then they should also be questioned why did they do that. In my opinion, what seems to be happening is that the CFO, the entire blame has been put on CFO, and the CFO has been asked to resign per se. But a thorough investigation must be done. On top of it, Vishy, over the last 1 or 2 years, Gensol has been continuously putting out positive press releases on the social media. The promoters are celebrating the rise in the stock prices. I believe if it's a good company, these are things that promoters should not really do, and the promoters should focus solely on running of the business. Outcome of the stock price is solely the discretion of the stock market and not the promoters per se. So, in my opinion, there must be a thorough investigation as to what happened. SEBI and MCA should get involved, and then lay out in front of investors what is going to happen. And mind you, with all of this episode, neither they will have access to debt products, neither they will have access to equity product, unless and until they have a white knight who says that I see the potential in the business and I am going to buy over the business entirely. So now,
Aditya,
very, very big problem.
right.
Yes.
So
Yes.
Aditya, speaking of the white knight, I think that is the only solution at this point in time, right? Because the two positives that could potentially play out for the company, one is that they do realize the revenues from Reflex in, say, about a quarter down the line, for which we have no specific timeline. And also, 9 months later, potentially we will see their US subsidiary sale come through, for which once again we have no confirmation whatsoever. I'm assuming that even if these two events do play out in favor of the company will still be in a lot of trouble, because in the near term, even over the next 3 to 4 months, cash flows are just not coming in, which means that in any which way the company is in trouble. Is this a correct way of looking at things?
Absolutely. So Agam, to reach 9 months, first you have to operate for 9 months. And today with the debt servicing rating of D, as Vishy already knows it, D means that no lender is going to touch you whatsoever. Your equity infusion with cash burn of around 20 to 40 crores would mean that you will survive for 1 or 2 months. How will the company survive after that? It can only survive if it works very rapidly to upgrade its rating from D to triple B minus or something of that sort. So the real problem for Gensol is how it is going to go through the next 3 to 6 months with no solution on their funding per se. Equity capital, they cannot keep raising equity capital. Today, the market cap of Gensol is about 1,200 crores. If they're already diluting about 10 to 15% of the company right now when they're raising 100 crores. And now again, if they go in for one round more dilution, there's a bigger problem for existing shareholders that their equities continuing to keep getting diluted. So now there's a massive problem of how will you go into the funding phase. Once your rating is downgraded to D, you are practically handicapped per se, and tough questions should be asked from the promoters per se as to what they were doing and why were these defaults not notified to the exchanges and to the investors that they were not paying their loans for 2 months per se. So a lot of questions, difficult time, but then that's how it is.
Well, fair enough. Aditya, we leave it at that. Thank you so much for taking the time out and speaking to us here at NDTV Profit. And of course, thank you, Vishy and Sajid. Yes.
Add
Yes,
one,
yes, Sajid. Yes.
The CFO which resigned lately.
Yes, that bit, yeah.
Yeah. He was appointed on October 7th, 2024.
Right.
So within a quarter, he has resigned.
He resigned, yeah. Yeah.
So you can't even blame him for
Whatever has
what
happened.
Absolutely.
Simple as that.
Absolutely. Well, fair enough. Of course, we'll await for more from the management themselves, but this is all that we have for this special edition for KYC. We slip into a short break. On the other side, we continue the coverage. Stay tuned in, and we'll be back in just a minute.